About 21,300, that's the opening print on the Nifty. A stable start, you'd have to say. At least you're not really seeing any weak links come by. Once again, the breadth of the market is where all the action seems to be. A 1,500 count already on the NSE advances side. That's the tilt of the market once again. Zomato, let's see what that's up to. The management has now clarified that they don't have any plans to buy Shiprocket. 1.5% higher for Zomato, 129 is where that stock is currently in trade. There's also Siemens, wherein the management is indicating their energy business is seeing a pickup in the private capex as well, and that they're going to be looking at mulling the demerger of the energy business. That stock gaps up 3.5% as we speak right now. GMR Airports, wherein NIIF is looking to invest 75 crore rupees in the Andhra Pradesh airport. GMR Airports has been a very active stock of late and right now as well holding higher by 3% as we speak right now. LIC, already in the pre-open rates itself, it's seeing a huge gap up. Let's see what that stock is up to, 6% higher, and I think it's already back to its issue price, if I'm not mistaken. I'm just going to dig out the issue price in just a second from now. Remember, the government has granted that 10-year from listing to achieve 25% MPS norm, and that's auguring well for the sentiment on LIC as of now. 361 after that City target price upgrade to 750. Let's see what that stock is up to, what delivery is up to. There's been a buy initiation by UBS, target price 500. And then, of course, SBI cards, like Ajay was just highlighting from that Jeffrey notes, that the card in force grew about 17% year on year. Spends have seen a 50% growth year on year. SBI cards not really seeing a meaningful move, however. There's Brigade International Enterprises as well, which has signed a lease agreement with one of the companies for a core technology for office space. So look out for that. Railtel, they bagged a order worth about 67 odd crore rupees. So that's another stock in focus. There's, of course, all cargo logistics as well. The international supply chain business is going to be demerged. Swap ratio is going to be announced. That's the commentary from the management. A huge gap up on all cargo, 8.25% higher as we speak right now. But at the index level, we're just about stable, Ajay. Anything that you're spotting?
Well, that's correct. Adani Ports is doing very well. In fact, several of the Adani stocks have rebounded very well, along with chemical stocks. UPL, look at that. That stock is also back. In last few days, we have seen chemical stocks make a comeback. The advanced decline overall in the market is almost 8:1. So the number of decliners are much lower, but still the Nifty and Sensex, Bank Nifty is not capturing big. In fact, GIFT Nifty was showing that there was no major gap up. Let's see. Let's wait for first half an hour of trade. Then we'll understand better whether we are continuing the upward move yesterday or it is a sideways move. The broader markets are relatively outperforming. 1% coming on small cap, mid caps to almost 0.5%. So broader market rally is much more livelier versus the large cap. Sawan?
Yes, indeed. Let's find out what our chartists really make of this open. And knocking on the doors of 21,300, it's pretty steady, you could say, especially when it comes to the broader universe. Naresh, your first trade.
So a good enough open, and we could expect some consolidation to continue now. I would go with ICICI Bank around that 1,990 mark, which is a retest of the breakout. A good risk reward trade here for a bounce back towards new all-time highs.
All right, there you have it. That's the first take coming in when it comes to the technicals. Devina Mehra is also joining in. Devina, hi, good to have you on board. I reckon it's all smiles given the kind of rally that we've witnessed after a pretty strong momentum that we saw during Diwali. It looks like the Christmas rally is on and here to stay.
Yeah, good morning. And yes, I mean, I have been quite positive on the market, generally speaking, at least on the large cap front for a while now. And as I've spoken before, it is just that there was enough room created with a huge underperformance through a whole decade of 2010 to 20, when instead of compounding 15-16% as we expect the market to do, it just compounded little more than 8.5%. So that room was created. We are still not above the trend line, so probability of a crash still low. The part to be cautious on is the small cap side.
Devina, hi, morning. Devina, you track global macro indicators as well pretty closely. I saw the way dollar index has cracked below the 102 mark. At the same time, if we look at the data which is being thrown up by a research team, that India is the biggest recipient of FII flows this year among all key emerging markets. And this, after this community sold India off in a big manner, it appears they are coming back. If this trend of dollar index crack continues, can this flow accelerate into India and emerging markets in your view?
See, first of all, I don't think the direction of, the reason why we want to track the FII flows is because we think it determines the direction of the market. But if you actually look at data over years, over months, whatever cut you want to take, the FII flows have very little correlation with the market movement. In fact, none at all. This is even when the domestic mutual fund and the domestic retail investor community was not that large, when FIIs were the biggest game in town. Even then, it did not have a correlation. The biggest proof of that is that FII money started to come in around 1994. And obviously, this was a new source of money, billions of dollars coming in. And 1994 to 2003 is the only 9-year period in the Sensex history or the Indian markets history which showed zero displacement. The markets went up and down, but there was no net displacement. There was zero return over 9 years. So this is not something that I track very closely or at all from the market point of view. The only reason why I do look at FII flows is from the balance of payment side, but not really this. So I don't think you should spend a lot of time really speculating on that. As of now, of course, the US has managed what can be called a soft landing, because there has been no recession, and broadly inflation is within control. Though one segment which hasn't really responded that much is what they call non-housing services. So that because the labor market has remained strong, but basically this whole the picture in the US has turned out better than what one could have expected a year and a half ago.
What do you make of the way macro data is coming in US? The Q3 GDP was weaker than estimated. Is it making a case of a rate cut in US by mid-year stronger, and would India follow?
Yes, US, the case is becoming stronger, definitely. And also the last statement from the Fed was more dovish than what I expected it to be, because they said that we do not want to overcorrect, in a sense, to remain tighter than than is needed, and further break on the economy, which is very different from what they've been saying up until now, that inflation remains number one and we'll do what it takes and we want the economy to slow down. So that's it. So while I was never in the camp that you will see a rate cut in 2023. If you go back year and a half, there was a lot of expectation that second half of 2023 itself will see rate cuts, and I was never in that camp because inflation takes time to come down. But definitely you will see a rate cut in 2024, exactly when. Mid-year is not a bad estimate, but one will have to see how the data pans out.
Even if you were to just, look back at 2023, there's conjecture out in the market that there's frenzy and FOMO, and that's most evident in what's happening within the IPO space. Even if you were to dig out data, 2021 actually had higher number of IPOs and money raised much more thereby than what we've seen so far this year. But do you sense some sort of exuberance there?
Yes, definitely. In 2021, I remember on your channel, Nikunj asked me that if I put a gun to your head, which IPO will you buy? The so-called new age tech companies. And I said, even gun to my head, I won't buy it. So, I think too much of mental space also, besides everything else, of the investor gets taken up by these IPOs. That's not the place to be, because, IPOs by definition are mostly risky areas. I was looking at some data in the 1990s. There were years when there were 1,100 IPOs and 1,300 IPOs. And today, if you look at the whole listed universe, which trades with some kind of regularity, it is just over 4,000 stocks. So a whole lot of stocks just disappear into the great blue yonder. So, if at all you have to look at IPOs, it has to be a basket. But obviously, as a retail investor, there's no way you have any predictability of when you get allotment. So there's no way you will have a basket. There are enough places in the market to make money. So that this is not something that you should spend any time or effort uh, investing in. So, I mean, basically, be cognizant of risk management. So small caps, IPOs, micro caps, the areas where there has been a lot of exuberance of late are exactly the areas where you have to be careful of and strictly limit your exposure.
Would that be the same prognosis for PSUs as well, and the fancied ones, the star performers, your defense, railway, across the board power and its ancillaries? And where do you think the rally would last? What will be the strongest of them all and the fittest of them all, where the rally would sustain into next year too?
That's not a space we are heavily invested in. At times we have held, defense PSUs and things like that. But again, our whole investing philosophy is to manage risk. And so therefore we are careful participating in any frenzies. And oftentimes many of these things go by newspaper headlines that so much order goes to so and so and so on, so on and so forth. But there are, like in projects, there are always delays. There's always, how much money you actually make out of it, because even if the project happens, almost always there is a cost overrun. So how much is to be taken by the government, how much is to be taken by the company? So there come like a lot of slips between the cup and the lip. So those things you have to be careful on. Again, not that you should not look at that space, but again, don't have overexposure to that space. Be careful. Investing is a loser's game. So first you have to ensure that you don't lose big time, and then the money will come. In terms of course, where we have reasonable PSU exposure has been banks, where we shifted away this year from private sector to PSU banks. So, we are heavily underweight banks overall, which has again proved to be a good thing this year. But within that, we will be skewed a little towards PSU banks than we used to be.
Interesting. Why would you do that, Devina? And that doesn't mean a clear exit from private banks, right?
Well, banking is the highest weight in the index. So if it wasn't the case, I probably wouldn't even look at banking. As someone was telling me that you keep repeating this statement that I am a nervous investor in banks and lenders. And if you look at even the performance of banks, we were heavily underweight also in 2020 and 2021. In 2020, banks was the only sector index in the negative. In 2021, it was up only half as much as the market. 2022, I think about the end of the second quarter is when we went market weight in banks, and that with price action at one point even became overweight. And 2022 in the last 4 years has been the only year in which banks outperformed. So I think index was up 4.5% and Bank Nifty was up 20% plus. So that has been, but again, this year our system started to signal it's not looking good. So we've been cutting back. And this year also, if you look, the Bank Nifty last I saw was up about 9-10% as against the Nifty being up 15. And as I told you, Nifty has a lot of weightage to banks. You take out the banks, and non-bank Nifty would have been up much more. NSE 500 up about 20% year to date. So it has been an underperformer. And with banks, basically, it's a leverage sector, obviously. And sitting outside, you can never know where the negative surprises are hiding. And this is a sector that always gives more negative than positive surprises. So in 2022, the cycle for 10 was benign with the NPA cycle behind them. And as interest rates go up again in the beginning, banking margins go up. So those were some of the positive. Credit growth was good. But now again, there are a lot of cautionary signs. So yes, we are quite underweight banks.
Okay, that's an interesting take. Thanks so much for joining in. Good to have you on board, and wishing you all the very best for the festive season ahead, Devina.
Thank you, and wish you the same and the viewers as well. Happy holidays to everyone.
All right, thanks so much. And well, it's a shade of green on the screen, but it's flitting really between the green and the red for now when it comes to the Nifty. Quite a different story when it comes to the broader universe. Check in on the mid and the small caps because it's convincingly holding out in the green. In fact, it's the small cap end of the market that's active. Names like MRPL, Cyient, Intellect Design, a continued rally on Hindustan Copper, JB Chemicals, they're all up and away in trade. But more updates then, and many ocean carriers have actually stopped their ships from using the Red Sea. That's following the projectile attacks that we've seen from Yemen, the militia base there. Let's, in fact, understand what exactly some of the key risks are and a detailed report on the same. My colleague Snehi joins in with the updates.
Well, on the 15th of December, the world's second largest container shipping company, Maersk, announced that it will suspend all container shipments through the Red Sea and reroute its vessels around South Africa's Cape of Good Hope in response to the attacks on its vessels in the Red Sea. Following this announcement, major players in this space like MSC, CMA CGM, Hapag-Lloyd and others have also followed suit, and Chinese and Taiwanese container shipping companies are considering similar measures, and there have been announcements about temporarily stopping accepting Israel cargo. Now, why are these companies looking to reroute, and what's the trouble that's brewing in the Red Sea? Iran-backed Houthi militants in Yemen attacked commercial vessels in the Red Sea to show support for the Palestinian militant group Hamas. The Houthi group has reportedly vowed to continue operations targeting Israeli ships or vessels headed to the Israeli ports. Now, what's the impact of these attacks? Analysts at BOFA say that around 28% of the world container trade and 12.3% of the crude tankers use the Suez Canal or the Red Sea route. That map will be on the screen shortly. Alternate routing via the Cape of Good Hope would add an average of 30% to journey times for containers, or about 22 days more on a round-trip basis. That is indicated by the red line on the map that shows an entire rerouting from the Cape of Good Hope all the way to Europe. Now, if all companies were to adopt such measures, this would cut shipping capacity on routes from Asia to Europe by roughly 30%. The Suez Canal is the quickest sea route between Asia and Europe and one of the key choke points for global trade. Recall the supply chain snarls caused when the Ever Given container ship got stuck in the Suez Canal for just 6 days in 2021, but disrupted around $9.6 billion worth of world trade per day. For businesses, the immediate impact will be felt via higher trading costs, like higher insurance premiums and delays in shipments given diverted vessels. This situation is likely to cause shippers to once again become mindful of supply chain disruptions like those seen in the past years, and analysts think that this is likely to put upward pressure not just on spot freight rates but also on the yearly contract rates. Analysts at Nomura believe it would not be particularly surprising for spot rates on this route to double or even quadruple. Now, while the impact of these attacks to be short-term in nature, we have seen a spike in crude oil prices over the last few days. What's the potential impact on India then? One of the biggest impacts of the blockage of trade or use of alternative routes is usually an increase in the freight rates as routes get longer and volumes reduce. Now, while this is beneficial to shipping companies, increasing costs of transportation and delays in shipments could have a much larger impact. Overall logistic costs are bound to rise, which Indian exporters and importers may find difficult to pass on to end users. As of now, it is too early to say and talk about the impact of this development on India's earnings story. However, we have seen a few shipping stocks like SCI and GE Shipping rise over the last few days, and some of the import-dependent sectors that could be impacted include textiles, oil and gas, chemicals, some capital good companies, metals, as well as pharma. So keep an eye out for all of these sectors.
Thanks very much for that, Snehi, just to put that in perspective. But we have our industry voice now joining us to help us understand and analyze the situation much better. G.Shivakumar, Executive Director at GE Shipping, is joining us. Mr. Shivakumar, good morning. Thank you so much for your time. We'll come to your business in a moment, which I'm assuming doing very well right now. But I want to understand what Snehi was bringing to the table. And this issue has been ongoing and has been worrying a part of the industry for last few days now. How do you see, and what is the data which you're reading?
Yeah, morning. Thanks for having me. I think the facts that she's put out, they are indisputable. The Suez Canal is the quickest way to get from east to west, from Asia to Europe specifically, and having to go around the Cape of Good Hope obviously reduces the effective shipping capacity and could result in a significantly tighter market. So that's absolutely true. And about 10% of the trade goes through the Suez Canal and could be affected if the situation continues. The situation currently is still evolving. So all the names that were mentioned are container players who have said that they'll take the Cape of Good Hope route rather than the Suez Canal route. So far, we haven't seen significant changes in any announcements from too many tanker companies. A couple of them have said that they'll avoid the Red Sea Suez Canal route. So, but if this persists, we have not seen a big change in rates except on the routes which are specifically dependent on that trade. So those rates have gone up a lot. So we haven't, not too much except in individual routes. But yes, if this continues, you could see a more widespread tightening of the market for tankers as well.
Interesting. Because nearly 28% of container volumes move from that area. But Mr. Shivakumar, what about shipping companies? Are they revising their contracts just yet, or are they still in wait and watch mode?
Commodity shipping companies like us, again, we are dependent on how the route that the customer wants to take. And we can choose, and these are negotiated on a voyage by voyage basis sometimes. If you're on time charter, then it depends on the clauses in your contract. People are tending to avoid the Red Sea and that route. However, it is not an overall, blanket ban like we have seen announced by the container companies. So it is. So if it persists, and again, we don't know how it's going to evolve. Maybe it'll die down in a few days. Maybe the proposed naval escorts could be effective. So if it continues this for a significant period of time, that means a tighter market for containers, which we are not in, and tankers. Dry bulk has less of an impact. 4 to 5% of the trade goes through the Suez Canal.
Kumar, just as per your understanding, what would you think really needs to change, or what really do you think needs to be done in order to resolve this and to make the shipping companies once again take this route?
So that's geopolitics, and we don't have any expertise there. Basically, we'd like it to settle down and for safe passage for all ships, because it's a big worry, right? If your ship is going there, your crew are there, you have cargo there, and you don't want anything to happen to your people, to the cargo that we're carrying for our customers, to the ship itself. So the ideal is for the whole thing to settle down, but that's way beyond our pay grade. That's something that needs to be settled between the players involved.
Mr. Shivakumar, let's shift focus and talk about the business then. Where exactly do we stand in the cycle right now? Because as we see it, the order books right now of shipyards and dry bulk carriers, all of them are at multi-year lows. Where do you see things shape up from here on?
Yeah, so the order books, as you said, are very low, which is good because future supply is somewhat restricted, at least for the next 2 years. The tanker market continues to be tight, even without this additional factor on the Red Sea. So the markets were, crude tankers were earning $40,000 to $50,000 a day on average. Product tankers were earning $25,000 to $30,000 a day, $25,000 to $35,000 a day on average. So that's still a very healthy market. Dry bulk carriers, which were going through a weak patch, are now much stronger. So the smaller bulk carriers are earning between $15,000 to $18,000 a day. The bigger, the Cape sizes are earning in excess of $25,000 a day. So across the board, there is pretty good strength. And LPG, of course, has been hitting all-time highs, LPG ships in the spot market. And apart from that, we also have the oil field services business, which is the offshore drilling and support vessel business, which has also been strengthening for the last year and a half. And every contract gets repriced higher than the last one. So across the board, we are seeing strength in a lot of our sectors.
Shivakumar, just a quick follow-up on that one. So what I get a sense from your answer is that the outlook for your business, at least in the medium to long term, talking about 1 to 2 year, appears to be good because obviously the rates could edge higher. There is a scope for that?
The outlook based on the fundamentals appears to be good. Again, we are driven by global macro. If you have a global event, if you have a global recession, which results in lower demand for commodities and therefore lower demand for carriage of commodities, that could be a dampener. We don't know how interest rates, play out. So that could come in the way if you have those kind of macro events. But shipping industry fundamentals are good. That we can say. So that's one factor at least which is in our favor. And absent any macro event, we should be okay for the next year or two.
The other thing also, Mr. Shivakumar, is, and largely for your business, I mean, in the entire pie, how much trade actually flows from the Red Sea region? I mean, could it be a big dampener per se?
Yeah, these things on the margin make a big difference. The shipping market lives and dies on the margins. A couple of percentage points in utilization change has a big in the rates. And I saw a number that you'd put approximately 10% of the tanker trade goes through it, plus minus 2%, goes through the Suez Canal. And if you have if you have ships having to spend 40% more time, those ships, okay, that means the market is tighter by 4%. 4% in an already tight market is a big number. Okay, so and once that happens, then it's tough to call what can happen to the market. And it's on both sides. If you have a 4% drop in demand, it's the same, that markets could collapse. So, and dry bulk, the impact is a little less because you have only 4 to 5% of the dry bulk trade actually going through the Suez Canal. And those are typically smaller ships. So, it affects individual size ships a little differently. So all of those have to be taken into account. But broadly, any factor like this which causes inefficiency results in a tighter market and therefore higher rates.
Fair enough. In terms of the offshore rig business, tell us how many of your rigs and vessels will be coming up for renewal in the next financial year?
Yeah, in the next financial year, we have one which is being renewed right now. She's finished one of her contracts and she'll probably go on to the next contract, which is at a much higher level in the month of January. We have 2 rigs coming off their earlier contracts in FY25. They will be coming off their contracts. We will bid, one of them has already bid into a tender, which is a 3-year contract. Now, we don't know the results of that bid. And the second rig will be bid into a tender in due course when we get a tender which is appropriate for that timing. And both of those will get repriced in the next year, and that's in FY25. And in FY26, we have another rig coming up for repricing.
Excellent, Mr. Shivakumar. Thank you so much for chatting with us today on your business as well as what's happening as far as the logistics space, especially around the Red Sea is concerned. Thank you so much for your time. We'll take a short break on that note. On the other side of the break, we have very interesting management coming in. City Union Bank, yes, that has been a very volatile bank and have underperformed the banking space lately. But what are the outlook from here on medium term and long term? Mr. Kamakodi will be joining us right after this break. Don't go anywhere. Yeah, so Mr. Kamakodi is now joining with us. City Union Bank is in focus. What has exactly happened over there? One of the brokerages last week, a few days back, put out a note, their inference and reading of how the QOQ growth of City Union Bank would be. Mr. Kamakodi, good morning. Thank you so much for your time. I'd just like to put it on record that last year, we saw there was a very meaningful correction in your stock happened because you came upfront and said probably the growth from here on would not be, you kind of tapered down the growth expectations of the market from your bank, and rightfully so. After a few quarters, you came back and said that the things are looking upward. Now this note which has come out with one of the brokerages saying that QOQ growth at your end perhaps would be flattish versus what the street was estimating 5.5% earlier. So I want to understand from you, where do we exactly stand right now on the growth cycle? Because I really appreciate nobody comes out and says that, look, we are going to grow slower than what we had estimated earlier, but you did it about a year back. And then you came back and rescaled estimates back. Where do we stand right now? If you could clarify.
See, basically, I would like to give you some background so that you can understand how things move and what is the basis with which we are giving you the expectation. Right from the beginning, growth versus profitability, our focus had more on profitability ratios. We had like said, decade plus where we had a CAGR of about close to 15% in the past, and when the even before the COVID hit us, in fact, we said that some things were not okay, and so we were downgrading the growth. But subsequently, during the COVID period, we managed the growth with the gold loan and ECLGS and all. We were able to get our growth back on track, and we had certain things we need to change. Basically, the lot of growth currently in the banking sector, we were focusing purely on the growth through branch network, and we had focused ourselves purely on MSME, commercial trading, agriculture, and gold loan and all. And recently, the bulk of the growth rate has been happening through the particularly the higher exposure to NBFCs, co-lending, particularly with the fintechs and things like that. We had been little slow, so that we want to understand the risk and take it forward, and that's why we scaled down something, and we also had some observations from the regulatory side which are behind us. So coming to the next side, we had to start basically with the loan origination systems upgrade and all. All those investments and all are currently on that, and we said we should be having about close to 12 to 14% for the current year, and there are certain headwinds, particularly on that and all. Even still, with that, we are taking our complete steps on that. But we had clearly told that we will be, for the first time, getting back to the 4-digit profitability figures, and all our return and profitability ratios, around 1.5% plus ROA, and all such things which got affected during the pre-COVID. All these things are already back on track, and we have demonstrated, and the growth is the last metrics we have to get back. We are on the job, and it is happening in stages. It is very, all these things, whatever we are doing, are to take bank for the next 5 to 10 years. Basically, certain capacity building and other things which need to be done are being done on technology side, on processor side, and things like that. So it's a process with which we had and some amount of plus or minus had been there here and there, but overall we are on track, and we feel we will be we are almost on all parameters. We are back to our best of our times, except the growth, which we should be able to demonstrate as we move forward. This is where we are.
All right. So thanks very much for that clarification. Let's just understand then, going down the line, what's the outlook in terms of your guidance? Are you going to stick to that 12 to 15% FY24 growth guidance? Any upward, downward revision? If you could just walk us through the details.
We still continue with our profitability growth guidance. Whatever we said, for the first time, we will be getting into the a 4-digit profitability figure, and we have crossed half of that in the first half. We are sticking into that. The exact growth guidance, we are by and large there, and we will be able to share the exact numbers when we share our Q3 numbers, when we will be giving where we stand. And even though there are certain headwinds here and there, we are putting our best effort to achieve those numbers, and the exact numbers we will be sharing.
All right. And what about the deposit repricing? Is that now behind us? Can we expect your margins to stabilize or perhaps even build up and improve from here on?
Yeah, if you had a chance to look into, say, our last, let's say, even 40 to 50 quarters, 80% of the time we used to be around 3.4 to 3.7, and about 20% we were above 4% and all. Some of the factors, like say, we used to operate at about 88, 89% credit deposit ratio and all, which we had to scale down to 80 to 83% subsequent to the developments that happened after the pandemic and all. And we had to particularly about 20-25 basis point below 4%. We were at about 3.7, 3.8%. We said our range had been the let's say the whatever we had in the last quarter around the same thing we should be able to stabilize. By and large, the repricing of the deposits is over, and hardly maybe about 10-15% repricing may be sufficient, and margins have been by and large stabilized with maybe 5-10 basis point here and there. It had moved on to the narrow range whatever we had already demonstrated.
Mr. Kamakodi, great to have you on the show, and thanks as always for those clarifications and the candid chat. Okay, we'll take a very quick break on that note. When we come back, we'll chat with the Narayana Healthcare management. Back with first trades right here in 89. The first trades have settled in nicely. Just want to check the markets before we move forward. So while the index may be flat, there's a good amount of perk up in names like Nalco, for instance. That's one of the top movers today. It's a 5.5% move that you're seeing on Nalco. Look at what's happening with Coal India. That's up 2.5%. Tata Steel is holding up 2%. Hindalco is up 2%. Adani Ports is holding out. Largely, the texture of the market is clearly tilting towards a favor of metals right now. They're the ones which are really holding up, while Hindustan Copper a double-digit move yesterday. Today, it's made another dash of 3.5%. Of course, the stock is in F&O band today. Piramal Enterprises holding up 3.5%. Coming back to metals, SAIL is another one which is perking up today. So metals clearly is the flavor of the day. But let's move on and let's welcome on board Viren Prasad Shetty, the Executive VC at Narayana Healthcare, joining in on the show right now. Viren, hi, morning. Good to have you on the show. Firstly, help us understand what's your assessment on the rise of COVID cases. As of now, do you think it's a concerning situation?
It's become a seasonal flu now. So every winter time, something one must just expect. We're not seeing too many serious cases yet, and neither have they reported it abroad. So it's not something we're too worried right now.
Okay. No, because the last two waves have been quite severe, right? And given this new variant, how vigilant should one be about the situation? Are hospitals geared up?
As such, December is a time when hospitals tend to be fuller than usual, because even if not the influenza, which otherwise does come about, people do get sicker in the winter time. There are a lot of lung respiratory diseases that happen. So with or without COVID, December anyway has a higher hospitalization rate across the board in most parts of the world.
I was looking at, please allow me first of all to take a question with you as a management on how the street sees your company, right? Because I admire your company, which you and your father are running so admirably, and it marries the social cause as well as the objective of profitability wonderfully. But still, when I look at the Bloomberg data, all the hospital stocks listed in India, somehow Narayana Health, currently on a 1 year forward basis trades at 30 times 1 year forward, which is half of what some of the larger peers of yours are trading at. I was wondering what exactly is the reason that street is not giving the same kind of valuation multiple as far as Narayana Health is concerned.
I'm not getting into guidance, but whatever projections we had made for how many patients a radiation oncology center would be able to do, which gave us the confidence to invest so much money into doing it, we have been able to perform well past that. So we're very happy with the performance of the radiation oncology, with the kind of reception we're getting locally. And now we just, we have much more confidence in the remaining block as and when it expands.
So what about the outlook then when it comes to how you plan to utilize your cash proceeds from the Cayman operations? Can you share with us, do you have any international expansion plans?
So we have two businesses, one that is in the Cayman, in the Caribbean region, and one is in India. And both are viable businesses for us to pursue. India is a place of great growth opportunities and where we will continue to invest the lion's share of our capital in the years going forward, because it is the largest and fastest growing market for healthcare in the world. So we'll continue to fund our India ambitions. But the overseas markets are something that we cannot choose to ignore. because we're able to leverage all that we have created in India to cater to a market where you can get some sort of arbitrage. May not be one-to-one cost arbitrage, but an arbitrage in terms of our superior technology, our superior operation expertise, our superior ability to run hospitals at a much lower overhead cost. Now, these things can be done in only very few geographies. There are few places we want to go to overseas, namely around the Caribbean and other Western developed markets. For right now, there's nothing that we have, and so all the cash that generated is being used to fund our expansion. But going forward, we will try to find maybe a couple of opportunities, in the absence of which the cash that we generate there would be brought back to India. We pay the tax on that and then be able to expand here.
Right. Lastly, what we understand is that if you use your Cayman proceeds to fund India acquisition or other expansion, you're liable to pay 25% tax. But if you utilize the same for dividend, then tax implications are nil. What are your thoughts? How do you plan to utilize the funds?
We have been giving dividends. We will continue to give dividends. And you're right. For the past 3 years, all of our dividends have been funded through Cayman. So we repatriate money from Cayman to India and from India to the shareholders, and that it's still not tax-free. It attracts, I believe, a 17% tax rate. And so it's a little more tax efficient than just using the capital for doing things in India. So the dividend in India, as our performance keeps growing, as the margins keep expanding, we have the ability to increase that. And so we will take that call as and when that comes. But the idea for right now, just so that there's less tax loss, is to try and match the two things together. But until then, we do see some opportunities abroad, which we would pursue, in the absence of which, yes, giving dividends in India is something we will pursue.
Thank you so much for joining us on the show today. All right, so the primary market is very active right now. There's another company which is in focus, Azad Engineering. This is a specialized engineering company focusing on defense and some of the high value engineering business. Vishnu Malpani, whole-time director at Azad Engineering, is joining us now. Vishnu, good morning. Thank you so much for your time. I was looking at your business model, and you have managed to clock very healthy growth. But what surprised me most is the kind of margins you guys are managing, over 30% margins. Talk to us about what goes into commanding that kind of margin in your line of business. And also, are these margins sustainable? Do you have an advantage to sustain these margins?
Sure. So first of all, thank you for having me on the show. So Azad Engineering, I'd like to say that we are in the business of manufacturing highly critical engineered components, right? We manufacture it for 3 sectors: energy, aerospace and defense, and oil and gas. Now, each of these sectors are, very, very long in terms of the gestation period that you need to sort of get there. So from the time you start onboarding a customer to the time you start, delivering parts to them, it's a cycle of about 3 to 5 years. So you have to qualify every part, component over years, and then slowly you, get to start supplying. So this industry has extremely high entry barriers, and that's why you would see there are only a few players globally that are, in this industry. In fact, we do not have a direct competition in India. So the parts that we are manufacturing are all mission critical and life critical. We call them Class A parts. These are the most complex parts that you can find in each of these sectors that I'm talking about. Now, coming to the margins, yes, we've been able to deliver consistently over 30% margin. In fact, the dip that you see in FY21 is also because it was COVID that year, and our factory was shut for 3 months. But we've consistently, if you normalize that, we've consistently delivered over 30%. And this is a result of the process engineering that we have at our end. Our gross margins are about 89% if you look at our RHP, and that is only because what you do after the raw material, because we do not have control over the raw material cost in our business. That is also controlled by the customers and OEM, and we only buy from OEM approved sources. So we do not have a risk of commodity prices fluctuations, etc. And whatever we do on the shop floor, which is right from sourcing of raw material to the dispatch of it, is completely process engineering. And we've been able to improve it year on year. In fact, we started this company in 2008. When it was started by our founder, we were doing about 10-12% margins, and we've consistently come to a point where today as a business we do H1 this year we've delivered 33.3%. And obviously these margins are sustainable because this industry works on long-term contracts, pricing contracts, etc. with the customers. So your prices and everything is, your revenue visibility and pricing is agreed upon with the customer for a longer period of time. And as the business scales up further, there'll be operating leverage that will come in, which will obviously improve this further.
Vishnu, yours is a niche products business, right? But there is just so much interest in this segment. Tell me, who are your competitors? How is it that you plan to build a moat around your business? And do your competitors as well enjoy the kind of margins that you are?
Okay. So this is a very, very niche segment. You've rightly put that. And also because, everybody today would say, we're a part of the aerospace defense. Every precision manufacturing company would say, but we'd like to differentiate ourselves by saying that we make parts that are mission critical and life critical, right? I mean, I could be manufacturing a seat for an aircraft, but we manufacture engine parts that are rotating, at 30,000 feet. So we manufacture that. So we do not have a direct competition in India. At a product level, if you ask me, obviously, there would be peers in the sectors that you can pretty much compare us because of the sector. But our competition lies outside of the country. So today we compete with China, we compete with Japanese suppliers for the customers. We also compete with Europe, USA, and Korea. So these are countries where our competition is actually based out of. The parts that we are making were not manufactured in India. And I think we are the only company in the supply chain of our customers that is from this region who's manufacturing and competing.
That would be making competition even more steeper, right? Stiffer, I would say. Global competition, because they have been in many lines of business such as these ahead of the curves, right? In the evolution of technology and innovation. So you must have scaled a lot of time advantage over in a lesser period of time. I want to know, what's the growth outlook from here on? Again, 25% growth is what you have clocked last few years. What is the visibility now with India becoming itself such a huge, buyer of your kind of mission critical equipment on the defense and aerospace side? Are new avenues of growth opening up?
Yeah, so if you look at the three sectors that we are operating in, today we started the energy business about 15 years ago, and we've today gotten to a point where we're delivering about 90% revenue of our business from there. Aerospace and defense we did about 4 years ago. Oil and gas we just started. So each of these sectors, if you look at it, we have less than 1% wallet share of the current target addressable market. Just to put numbers in perspective, I would say that we are addressing a total of $22 to $4 billion sort of a market between these sectors. So our plan is to prepare for the growth that we see in the sectors coming. And that's why any proceeds that we have are going to be eventually deployed in growth capital. So we are deploying them in two areas. One of them is to create infrastructure. So we are adding about 8 times more capacity. The second is to put in plant and machinery. So we are also increasing our capacity to cater to the growth that we see in the industry. I wouldn't be able to give you a lot of guidance for the right reasons, but I can tell you that H1 we've done 158 crores with an EBITDA of 33.3% and PAT margins of about 26 odd crores. So, and we are continuing our quarter-on-quarter growth. So I think you can make the right estimate from there.
Talk to us about what are the scale-up plans on facility, plant and engineering you were talking about. How are you planning to add some, the right kind of manpower? Because that's also a very important ingredient in your line of business. If you could tell us from the proceeds, internally also you included, of course, from the IPO as well.
Yeah. So I think in our industry, you don't find employees or manpower that's readily available. So we have a very strong training and development plan internally where we hire people ahead of the curve. We plan them and keep them ready. So if you look at it, our manpower cost last year was slightly higher. This year is going to be more normalized. So last year we had about 23%, 22 to 23% manpower cost, but this year if you look at H1 also, it's normalized to quite a bit because we have to hire people ahead of the curve, train them and keep them ready. And that's what we're constantly looking at doing. So we get people, graduate engineering trainees, we get, diploma holders. We also get a lot of people who are working in ITI institutes, etc. We train on rigorous programs, have them shadow the right resources and projects, and then we deploy them into making these life critical and mission critical parts. And
Quite.
yeah, sorry.
No. Please go ahead. Finish your point.
No, I just realized I missed maybe the second part of the question where you was talking about infrastructure. So I think the proceeds are going to be deployed right now. 240 crores are going to be deployed towards paying off debt of 138 crores, 60 crores in capex, and the rest for general corporate expenses. Eventually, as we create our infrastructure, we're going to take debt from the syndicate that we have, term loans, and then keep deploying capital in a very effective manner so that we're able to reach our milestones. So our current capacity can take up to FY25, our projections, and from FY26 onwards, we move into the newer plant, and then incremental revenue starts coming out of the newer plant from FY26.
Right. Vishnu, the talk in the newsroom about your company is not just the IPO, but also the sports connect, right? As per our understanding, the likes of PV Sindhu, Saina Nehwal, Sachin Tendulkar, all of them are invested in your company.
Yeah. So yeah, I think that's been a surprise for us also. I think most questions that I'm getting on financials, I'm getting more questions on the other side. But I can only tell you that while we were raising capital about a year and a half ago, I think we had interest from each of the names that you said. And yeah, I think in terms of the available pool of investors, we were happy that we had interest from such eminent personalities, and the board approved them having us as shareholders. There is nothing more to this, because in this industry, I mean, we are not in a B2C industry. We are in the industry where there are fewer customers and even fewer suppliers. So yeah, that's all I can tell you.
Good luck with that, Vishnu, and we'll see you on listing day as well, hopefully.
Yeah.
Okay. We'll take a very quick break then on that note, and lots more on the other side.